What's up? This is Damon Vario from stockbarometer.com and damonvario.com. What we're going to be talking about today is gap trading strategies, and I think there's a lot of misconceptions as to what exactly gap trading is. In my experience, when people talk about gap trading, they don't tend to talk about the same type of gap trading. So I'm going to give you a list of a few types of gap trading, and I'm going to tell you a little about each of them, their advantages and disadvantages, and how to do them. But first of all, let me say I am in the process of moving, so I'm in a hotel. I don't have my camera set up very well, got a pretty shitty microphone up, so I'm going to try to do my best to give you all of these gap trading strategies in a very low preparation type of way. So let me give you a list of 3 types of gap trading strategies that are actually profitable and possible. They are day trading gaps, predicting gaps, predicting a breakout, and then riding that gap, and finally post-gap trading. So let's start with day trading gaps. Now, the fact is, pretty much every day, every stock has a gap. Every single stock starts out as a gap. In other words, you won't ever see the opening, you'll rarely see that the closing price yesterday is the exact same price as the opening price today. Where do we see that in this chart? It'd actually be better to look at Yahoo. It's bigger. Gaps happen every day. And the majority of the gaps, I would say, I haven't looked at the statistics, but 99% of the gaps will close within the day. So let's look at these gaps. Now, why did I show a picture of gaps at the first? Well, because there are lots of different types of gaps. I wanted to give you an idea of what a gap is. There's a gap right there, right? Here's a gap right here. Gaps are visible via candlestick analysis. You switch your chart to the candlestick chart, and you'll see gaps. Here we have a gap, a big gap in Yahoo. Gap is simply where they disconnect. The 2 candlesticks disconnect. Now, when I'm talking about day trading gaps, what I'm talking about is buying or selling, shorting a large amount of stock so that the gap closes and then taking that profit. Here's how it works. Let's say that yesterday, Yahoo right here closed at 43.38. And as the market opened on February 25th, you saw the opening price was 43.21. In other words, the opening price on the 25th was lower than the closing price on the 24th. Now, as soon as the market opens, what you want to do is buy the stock because you know that the gap is going to close. So you buy the stock and then you take the profit because you're probably going to see a green candlestick here. So basically, you're flipping around. On this day, the closing price was 43.53. The opening price was 43.56. So you would have shorted the stock and you would have lost a tiny bit of money. But basically, what you're doing is you're making a bet that the gap will fill every day. And actually, they do fill every day. Here, you wouldn't have really lost money because you see these little shadows. They actually filled. So if you opened here, if you bought the stock on February 9th because the opening price on February 9th was lower than the closing price on February 6th, you would still make money because the stock still went up in price. If you can see that shadow, it still went up in price. Now, when you sell is the difficult part of day trading gaps. The advantages and disadvantages of day trading gaps are pretty simple. I don't really day trade gaps because I don't have that kind of capital to pour into one stock for a short period of time and then take it out later. The advantage is this. You can almost always be right. You can almost always, like 99% of the time, be right on your bet. If you see that the opening price today is below the closing price of yesterday, buy the stock price almost definitely will go up, then you sell it at that at whatever price target you determined to sell it at. That's the question of day trading, actually. So that's the advantage. The disadvantage is simply you need a lot of money. You can't do this with $100 because you're going to be losing out on commission. Let's say you're going with the average brokerage like Ameritrade or E-Trade. You're paying $10 to open your position and you're paying $10 to close your position. So if you're gambling with $100 on a stock, you're paying $20 to do that. So you've got to be making at least $20 per trade. And that's really not easy with a stock like Yahoo because it's trading at a lower region. You might be able to do it with Facebook or Apple where the movements are larger. You can see a 1% movement is a $1 movement there. So if you're buying 100 shares of stock, well, you could have to put in about $8,000 and you'd come out with about you come out with $800. So that's okay if you have a large amount of money and you're willing just to go based on statistics and not to do what most day traders like to do, which is, tell themselves that they're playing stock, they're a gambler, they're a professional day trader. They look in all these directions for all these different, indicators. This is a very simple strategy. So if you're day trading gaps, it's super easy. You just try to make sure that you have enough money to put into the position so that when you close at whatever price target you're looking at, you come out with profit that doesn't really get eaten up by the commissions. Like I said, this isn't really my preferred way of gap trading. I generally stick with the other two ways of gap trading. Now let's move on to breakouts. What is a breakout? Breakout is kind of a gap like this. There's a small gap right here, but you see there's a breakout because prior to February 19th, the stock was more or less flat. It stayed within this 47 to 77 trading region, and only at February 19th did it actually break out of 77. What you want to do with this kind of gap trading is you want to be able to predict the breakout. You predict the breakout based on three things. You need to look at the candlesticks. You need to know candlestick patterns. Here what we see is something very similar to what's called a morning star. You have a red candlestick here, a smaller candlestick which can be red or green down below, and then a green candlestick here. When you see this three candlestick pattern, almost always, most of the time, the next candlestick is going to be upward. It's going to be bullish. So on February 18th, you could predict, if you're using this method, that the next day's candlestick is going to be green and up higher. So you would buy at the opening price, you ride that trend, and you got the breakout. You got it right there. But just the candlesticks alone isn't enough because candlesticks can tell you a movement direction pretty accurately, but it can't tell you whether something's going to break out or not. To do that, you should pay attention to the news and gossip. These are two things that tell you that there might be something coming up with that company or with whatever ETF, or like let's say you're playing an ETF on an ETN on gold. Okay, if there's something that's going to happen with gold in the future based on your research of the news and the gossip, you can see that a news event might occur that might spike the price. And when that happens, usually what you're seeing is a large volume associated with that breakout, like we're seeing here. If you look at the bottom, this represents the volume of people buying the stock, and it's much higher than the days prior and after it. Now, where would you find this news and gossip? You can find news at MarketWatch. If you go to MarketWatch,